Welcome to The Buck Stops Here. I'm Catherine Murray. Well, markets have certainly hit record highs recently, almost opposite to what the consensus has been thinking. The bearish narrative has focused on inflation concerns, rising costs, supply chain disruptions, peak earnings, and also peak monetary stimulus. And yet again, the market seems to be looking through those headwinds. We'll see if that continues to be the case. I thought it would be useful to bring to you a panel discussion with perhaps differing perspectives. We shall see. Let me now introduce Kevin McSweeney. He's Senior VP and PM at CI Global Asset Management. Brandon Austin, CEO and President of Venator Capital. And also Joey Mack, Director and Head of Fixed Income Trading at Richardson Financial. Welcome to all of you. I'm so glad we're able to do these panel discussions once again. I think that hearing different views from institutional money managers and traders such as yourselves is very, very valuable. So welcome and thank you.
Thanks, Catherine.
Thanks.
It's an interesting day today, apparently. The BOC, Bank of Canada, had maybe a bit of surprising news. And that, of course, is so important as it relates to setting rates, rate expectations, the pressure it can put on valuations. Joey, as head of fixed income trading, let me ask you, what exactly in your mind did the BOC say and do we care?
Yeah, I think we absolutely care. The big news, I guess, was they did put an end to their quantitative easing program. So they're no longer going out and expanding their balance sheet. This wasn't too much of a surprise. It was, I think, maybe a meeting or maybe two meetings earlier than the market had been expecting. But nonetheless, it happened. Some people were calling for it. But the big thing, I think, was their change in view on inflation, where they've talked about, perhaps some of these transitory effects are going to be longer term impacts. You're going to see inflation a bit higher. Although they think this is still a near-term spike and we get inflation back towards 2%, overall, the general view is that they're going to start hiking rates perhaps sooner than anybody had really been expecting. So we're looking maybe, Q2, early Q2 even to get the first rate hike from the Bank of Canada.
Early Q2. That is much earlier, I think, than most people were expecting, and certainly much earlier than what we're anticipating the U.S. Federal Reserve is going to be doing. Brandon, let me ask you, what's your interpretation of this as it relates to the equity markets? And also, I think your concerns surrounding all of the liquidity in the market. I mean, at the end of the day, this perhaps pulls back on the liquidity.
Yeah, I don't know. It's, you're looking at Canada just sort of jumping ahead of what the U.S. is trying to do right now. Again, they'll be a little bit delayed. But I think they've all kind of lost the plot. I think they've all kind of lost control. Again, don't fight the Fed is the classic argument. But I think that people are willing to leverage themselves up the most they can in sort of the fear of missing out type context. So I don't know how much of effect this has on equity markets. And also, you look at some of the inflationary forces out there, and I was a big not proponent, but I really believed inflation was going to go crazy this year, and then I think it's going to ease up next year as well. But in terms of Canada, tell me what oil's going to do, tell me what copper is going to do. I don't know how much room there is right now for the government to influence housing prices in light of how houses are being bought, where that money's coming from. I feel like both the Feds on both sides of the border may have lost a bit of control here.
Well, and that's the biggest risk, right, for the markets, I think, or any asset class likely. Kevin, from your perspective then, if in fact, if you believe, and we can all talk about this, that maybe the BOC and or the Fed is kind of losing control, that's been the biggest risk out there, that there could be a mistake in terms of the policy being implemented. What's your interpretation of that comment?
Yeah, I'd say losing control. I'd probably disagree with Brandon a little bit that, I think it's probably beyond where they thought it would be. And to have an expectation be missed is one thing, and to be losing control, I think losing control is within the scope of possibilities. But I think, honestly, you have a Bank of Canada that's very credible around the world, that has a very good target, and is looking out, I guess right now it's probably looking out about a year and saying our output gap is going to be closed. That's going to create some more permanent inflationary pressures. I think when you look through that, I think that you're having a gradual, we're still at negative real yields here in Canada. That's still very risk bullish. That's still very good for equity markets, and particularly if it's backing up, as Brandon mentioned, tell me what oil is going to do, tell me what copper is going to do. And if you tell me what rates are going to do, then you've pretty much got that the Canadian market is probably, if all of those things are going up, then the Canadian market is going to be going up. So I think that you're probably looking at maybe a little higher than expected, but not out of control here. So I don't think that the inflation story in the medium term derails the bullish risk asset story with over tightening or over hiking.
So certainly a lot to pick up on there in terms of, why the BOC is pulling forward their rate hikes. I mean, and closing the output gap perhaps sooner than people were anticipating. That really does suggest a stronger economy. I mean, do we think that that's really the case right now, or is this an inflated economy driven by easy money? Brandon, why don't you answer that?
Well, I think that we have to be very conscious of, we always take our cues from the States. The States is in a much different position than we are in Canada. So the States right now is looking great. It's on steroids. They've got the easiest year-over-year comparison you've ever seen. Those will get tougher next year. Yes, maybe not, because we've got inventory constraints this year. That's going to ease up next year for the States. So maybe they'll have 2 years of good comps. Canada is a completely different story. So our main economic center, which is Toronto, is still partially shut down. So our easy comps are coming next year. Our sort of retailers, showing 40, 50% growth, that's in front of us. In the US, that's kind of behind us. So I don't really know how to measure, do we have a strong economy? Do we not have a strong economy? Because our comparisons are different. We're really not going to know until we're comparing. In the US, we're going to compare 2022 with 2019. In Canada, we're going to be comparing 2023 with 2019, because we're not going to know. Cineplex is still shut down. Air Canada is still operating at like a third capacity. So I think that it's difficult to say, is our economy going to be so crazy strong? And because we've been so generous with our subsidies, we've had that sort of situation where people are still making some money, but their expenses are still like zero, because they're still, for the most part, not working yet. So I think the Bank of Canada might have been a little early on this one, but it was going to happen eventually anyways.
It's interesting to try to figure all of this out in terms of where you want to be overweight versus underweight. A lot of people will always say that the fixed income market people are the smartest people in the room. I'm an equity person. Kevin, you're both. You run a balance fund. So, Brandon, you say no.
I've got a bond fund too, so I look at both. But
okay.
Yeah,
I guess I'm the only equity person. You guys are all smarter. So,
I got both.
But the point is that if it's the equity, if it's a fixed income market, Joy, what is the fixed income market telling us? And I don't mean just the knee-jerk reaction necessarily today, but the strength of the economy.
Well, the last 6 weeks we've kind of, I guess, been a precursor to this move. Is rates have moved sharply higher in the short end. The curve has flattened. It's been, that's kind of set us up for this meeting. If anything, I know the Canadian bond market at least is saying, yeah, we're going to start to see policy normalization coming in the next 6 months. You're going to see higher rates. Those negative real rates are going to disappear. Hopefully that's a good thing. I think having real positive returns on your cash is always going to be beneficial for everybody. So what does that mean? I take a bit of a different tack that, things are actually pretty good in Ontario. As much as the downtown core in Toronto is still a ghost town to a large degree, that's starting to change. I think in January, that's definitely going to change a lot more as we obviously see some of the pandemic restrictions wind up. So that's going to be very good for retail in the downtown core. Sure. Whether that's a shift from online back to physical stores remains to be seen, I think. But I think overall, we're in a pretty good situation here in Canada. So doesn't mean I like fixed income as an asset class right now. It's, rates are going up. It's terrible. I don't want to know anything in fixed income. But it's a good sign for the economy overall is what the rate market's saying.
Okay. People want to know, regardless of how they're invested. If they have somebody helping them with their investments, or they're running a small business or trying to build a business, that's why I want to kind of focus a little bit, or wanted to focus on the economy. But let's get back to a little bit of investing here. And Kevin, let me turn it to you in the sense that I feel like for how you manage money in terms of being an international investor, balanced, you can do fixed income, you can do equities, infrastructure, dividends. I think that this is almost a bit of the sweet spot for you.
Yeah, it is actually. We've been doing some work on sometimes investors are a lot like weather forecasters, and well, not just because they're often wrong, but because that you're looking at circumstances and you're saying, every time there's a storm front coming in from, Thunder Bay or whatever, it's going to rain in Toronto. You kind of look at the backdrop and you say, how does this, when the backdrop has been like this in the past, what has done well? When you're seeing an economy, a global economy, decelerate, but still stay positive, which I think is consistent with everybody's expectations. Q3 is going to be weak, but a lot of that, because of excess savings, deferred consumption, are going to be moved into Q4 and into 2022. When you see that deceleration, I don't think rates are going to move a lot higher than that. But within infrastructure, within real estate, within some of sort of the rate proxy, perceived as rate proxy, I can quibble with that. When you see deceleration in the economy, but it's still growing, you do tend to have a really good time for infrastructure.
We're kind of just getting into how and where the three of you are invested, where you see opportunities. And Kevin, I want to pick it up from what you were just saying in terms of the setup, in terms of, growth is still positive but decelerating. It sets up a nice opportunity perhaps in maybe some of the dividend plays and infrastructure plays. Talk to us a little bit about what you're doing in your portfolio.
Sure. Historically speaking, you've often had within infrastructure, you have a lot of operating leverage. You have a pipeline, and whether it's, pushing more energy through, or a utility that's pushing more power through, you're just looking at a set of growing cash flows with the economy continuing to grow, but then the discount rate being applied to that, maybe not today, maybe it's not topical today, but shortly you're going to have that discount rate feel a lot better. And so the valuation placed on those. That's within the infrastructure side. I'm actually structurally bullish infrastructure for a variety of reasons. Long-term money flows, consistent cash flows, and then government bond yields being anemic. Within sort of our more balanced or straight Canadian and global equity, we are bullish financials. That I think, particularly in Canada, I think you have a couple of catalysts coming up, perhaps with the OSFI meeting allowing for some capital returns coming up, after the new government is sworn in, after a new OSFI meeting. And I think, there's not many oligopolies with ROEs in the high teens trading at about an 11 or 12 times PE. So we're structurally long Canadian banks within Canada and feel very, very comfortable with that. And around the world, we've been long materials and energy. It's been a good trade. We're taking off some of that beta right now. So that's kind of where we're positioned and where we think the puck is going.
Okay. And Kevin, just kind of wrap it up there on those points, those areas. Your top stocks then within pipelines, infrastructure, and telecom financials?
Sure. You know what? There's a few of them. I'll just throw a couple out with a couple of hits you can pursue or not. Look, within telecom, cover telecom. We really like Telus. We think they've pre-funded their CapEx. They have a competitor that's subject to a bid. They're going up against Shaw, but they're technologically advantaged. And I think they're strategically advantaged, with Shaw being a little bit distracted on the Rogers bid and all the things going on there. Within pipelines, we actually prefer a U.S. pipeline largely. It's called Hess Midstream. It has a very tight relationship with Hess Oil, famous oil company in the Bakken. Basically has a singular set of contract, a very fixed return at a very high level with a great balance sheet and good exposure to what we think will be growing energy production in the Bakken. Throw in a 7.5% dividend yield, and that looks at a reasonable valuation. Looks extremely attractive to us.
Okay, Brandon, let me turn it to you for a moment here. Your style is a little bit, well, obviously very different than Kevin's. More of a bottom-up, and I think, and growthy approach. Talk to us just a little bit about your approach before we head to break, and then we'll get some ideas.
Oh yeah, we're definitely we're bottom up, but sometimes going bottom up shows you some more secular and industry themes. So a bottom up can turn to a top down, but we're not gonna, I'm sure Kevin doesn't either, but we're not gonna shotgun everything. I would agree in financials, like they're all gonna move together. If you're gonna own one, you should maybe diversify on the bunch because they're going to be correlated. So we don't necessarily look at those correlations. We're probably going to just like, okay, well, we like BMO and RBC, but not those two. Which Kevin's approach is probably a little better on that basis.
And so, in terms of other areas, though, that from a thematic perspective, what resonates today?
Well, like I said before, I am worried about the easy comps versus last year, the tough comps, U.S., Canada. So we are looking at larger secular themes. Things I like would be housing, not in terms of house prices, but in terms of construction materials or in terms of furnishings and stuff like that. We're also looking at job mobility as a huge theme. In the resource space, I'm not a huge fan, unfortunately, of oil and natural, not oils, less the natural gas. I'm okay with, but these are very, very cyclical. But I do think that there's a big secular call in copper. It goes to infrastructure, it goes to electrification of everything, and it goes to the fact that it takes a long time to put a large copper mine in production, and they're just not going to get there fast enough for the demand that's coming in the next couple of years. Structural copper shortage coming. They could send copper to like $8 in a few years. So those are sort of the thematic things that we're looking at right now.
Okay, and I think as well from a thematic perspective, there's the same argument has been made with the energy sector. I've got 10 seconds, but do you agree with that, Brandon, that the supply
Well,
demand
yeah.
dynamics are just totally out of whack?
I mean, only very short term. You can bring production so quickly now. When rig counts go up 10 rigs now, it's like coming up 40 rigs like 10 years ago because of just the technology changes.
All right, we are back and getting some very interesting and insightful investment thoughts and perspectives. Joey, let me ask you, in terms of, we started the conversation today about the BOC, the Bank of Canada. Rates are rising, bonds are falling. You don't want to own fixed income per se, and yet you're the head of fixed income trading. And people at home want to own fixed income. They want to know that their money is going to get returned, at a certain level without perhaps the risk that they perceive in equities versus fixed income. So what do you do for your clients these days?
So we haven't changed, and none of this that's happened today has really changed our view. I mean, we're underweight fixed income as an asset class in favor of cash, equities, and alternatives, and that doesn't change. Within fixed income, we're still short duration, overweight credit. Again, that doesn't change. When you look at the cycle, the economy's still growing. This is still good for credit. I mean, credit's performed very well and spreads are relatively tight, but there's no reason to change that given what's going on underneath a lot of these companies. I mean, they're doing very well, so we're still there. The one area we've consistently been overweight here too is the pref market for the last year, which has had a huge run. I think it's actually beaten the TSX. A lot is actually supply driven in the pref market. What we've seen over the last year and a bit is, the big banks, the big insurers have introduced these limited recourse capital notes into the institutional wholesale market.
Right.
What they're doing with that is that's cheaper financing for them than the prefs. They're calling a lot of their older, higher reset prefs, and that's going to continue. Royal Bank actually just came out and filed for a new institutional pref in the institutional market. So they'll be issuing that and then issuing more LRCNs, which means, again, they're probably redeeming or not issuing more preferred shares. So the supply demand dynamic in the retail pref market is still very good. So I think you want to still overweight there for now, and that's going to play over the next 6 months.
Okay. Brandon, I'd love to get a couple of ideas from you as well. There are names that I haven't heard of. I will only have like about 2 minutes. What's the Lovesac?
Yeah,
what is that?
I love bringing up the names people haven't heard of. Lovesac is a couch manufacturer. Just go to the website, lovesac.com. The worst part about this business, they don't sell their products in Canada. Basically, I mean, the short of it is that it's sectional, so it's not high fashion, but it's sectionals. And anyone who has a sectional knows there's no way to get away from sort of the blockiness of a sectional. So what they've done is they basically disassembled the sectional and they send it to you FedEx in basically 3x4x1 boxes. Okay. And, they are high end. They get put together well. Everyone knows that every sectional anyone's ever owned has to be snapped together, regardless whether installer does it or you do it. But the key is, again, it's high end, and you can just imagine when they're shipping it that way, how many they can get in a shipping container. And so the short of it is that go to their website and look up Christmas delivery, and you'll see that these are probably the only guys that can ship you a custom couch, a custom sectional, high end, 80 fabrics to choose from. You order it by, I think, November 27th or something, you'll get it by Christmas.
Okay, but Brandon,
anyone else, you're waiting like 6 months.
So then how and why are they able to do that? But also, how and why are sectionals so interesting or popular to you? I mean, I thought they were too big and heavy.
No, everyone, look, a lot of houses have sectionals.
No.
They've got them in their basement, they have them in their main floor. But the beauty of this sectionals, they have this thesis that's called design for life. So if your kid takes a Sharpie to it, you can just take the fabric off, call them up, we'll send you another fabric for not just a pillow, but like a side or a back. And because they never changed the design, if you move into a bigger house, you can order 3 more sections, right? And then the cool thing they did, and this is actually a lot of fun.
It sounds like the way
it's very cool.
my husband would decorate.
Yeah, look, it's very cool. Just go to the website and check it out. But what's super cool about it, and again, this was 30%, there's 50% growth going into COVID, 50% growth through COVID, still growing by 50%. And what's really neat is they just came out with this really wicked add-on, and you can see it on the website. So what they do is they actually have speakers integrated into the sectional, but they're completely invisible. So what happens, you've got surround sound. So you've got a subwoofer underneath, you've got a center channel, you have speakers at the front for left, right, and then behind you for surround. For people who don't have the wiring set up or you live in a condo, right? It's Harman Kardon, so it's real. But the really neat thing about it is that they use the same covers that you've always had. So you can put it on an existing couch you bought 7 years ago, right? And just reuse your covers. And then when you do the app, they say, okay, well, I've got the chenille or the linen and it's blue and the whole thing's tuned. So you can't see them.
I'm going to have to look at this.
The sound comes through perfectly. It's crazy. It's crazy.
If it has a fridge, I'm the next customer.
Exactly. It has a
Exactly.
fridge. It sounds like a perfect man cave. We got to leave it there.
Yeah, okay. I was just going to say, I told the guy, I told you can't buy these in Canada. And I told the CEO, I'm like, dude, not being in Toronto is like not being in Chicago or Austin, Texas.
Okay.
You need to get your Best Buy, relationship on the phone. Just have them sell through Best Buy because they do that in the States as well. And
Perfect.
it's a very cool company.
We got to leave it there. Great to see you guys. Thank you so much for the discussion.
See you later.
Thank you.